Alright, in this problem we're going to walk through Joe's financial deliberations on whether or not to buy a new mobile food truck. He already has a fleet of mobile food trucks out there, and so he's thinking about buying yet another one. There's a food truck available for $75,000, but it would need inventory of $18,000 to get it ready to open up for business. He'd also have to buy a permit and then pay some fees and register the truck and all that, which would be about $8,000. And then there's a renewal fee, which would be $3,200 per year, payable at the beginning of each of the subsequent years. His experience has been that it averages about $1,300 per week in salary and expenses to operate the food trucks, and those salaries tend to go up roughly 2% per year. The food trucks typically last 4 years, and then they can be traded in or scrapped, and his experience is he gets about 30% of the original cost back when he trades it in or scraps it. When he closes the food truck, he could also sell off any of the ending inventory, so instead of replacing inventory as he went, he'd just finally sell it all off on the last week that he owns the food truck. So those cash flows would be returned to him at the end of the 4th year. He thinks it'll be about $4,500 per week, and then that the sales will grow by about 5%. He also does not think the new food truck would cannibalize any of his existing food truck sales, because if it did, he'd have to recognize that it's cutting into his other profits. So it's a new food truck with a new brand of food parked in a new area that isn't going to screw him out of any of the money he already has. Gross profit margin on the trucks, typically 45%, so the cost of goods sold is about 55% of revenue. He's got income taxes of 40% based on the pre-tax operating profits, and he estimates his cost of capital is 10%. Small businesses don't go to all that complicated calculation which we showed you for weighted average cost of capital. They typically use a rule of thumb or a heuristic, and 10% is a pretty good number. So that's the one we're going to go with. Alright, so now what we want to do is calculate net present value, internal rate of return, modified internal rate of return, profitability index to measure, is this a good idea mathematically? Alright, well, we got to first put in all the cash flows. I, the truck, and that would be at time 0, 2, 3, 4, and then he's going to sell the truck at the end of there. Alright, so if he bought the food truck is $75,000. So he'd be out $75,000 to buy the truck, but then he also needs to recognize he sells the truck or trade in or otherwise gets rid of it at 30% of cost at the end of the 4th year. So 30% of 75,000 means that he would be bringing back in 22,500 over this period. I'm going to make go ahead and format all the numbers up so it looks pretty. Okay, notice that buying the food truck's a negative cash flow, selling the truck is a positive cash flow. He's got to buy inventory, and in the problem it says that the inventory is $18,000, which is a negative because you got to buy it. But at the end of the 4th year, he gets to sell off the inventory. So he'll recover the $18,000 there. Fees and licenses have to be paid up front, and the fee and license is $8,000 shown there, and then it renews at $3,200 a year. So that's $100,000 in the first year, and then he has to prepay the license of $32,000 in each of the other years. Doesn't plan to hold the food truck more than 4 years, so for planning purposes, he's only going to need licenses for this year, next year, next year, and next year. That's 4 years of licenses. All right, so we got any other expenses in here that would occur to get started or that would occur at the very end? We would be factoring those in as well. And we don't, so what we can do now is start calculating his after-tax operating cash flows. And what we want to do is assume that all the revenue and the expenses are for cash, the income taxes are for cash, but we also have to add back the depreciation expenses on the truck because those are not cash. All right, so after-tax operating cash flow is basically calculate the after-tax operating income and then add back the depreciation expenses because they're not a cash expense. All right, so we go out here with revenue. The revenue number that he's working on, $4,500 a week, and it grows about 5%. So in year one, that'd be $4,500 per week, $234,000, and then the next year it'd be 5% higher, and the 2 years after that. So that's 5% growth. The cost of goods sold, and it gives it in the problem, the gross profit margin's 45%, so the cost of goods sold would be 55%. So the gross profit at 45%. All right, so that's 55%. Draw a line under it. Then the gross profit, 45%. All right, the other operating expenses, and that's the sales and stuff, he is projecting that the cost of operating the truck is about $1,300 a week in salary and other expenses, and they grow about 2% a year. So $1,300 a week times 52 weeks, and then those grow at an inflation rate of about 2%. And then there's the depreciation expenses. Now, depreciation is a non-cash expense, but you get to reduce your income taxes when you pay it. So depreciation on the truck. The truck's going to cost $75,000, and that's a depreciable basis. He wants to depreciate it down to $22,500. Now, we're dumbing down depreciation just for this example. It doesn't actually work that way. There's special tax rules, but we're going to just use straight line depreciation. So he's going to have to depreciate the $75,000 down to $22,500. Okay, so that's a grand total of $5,250 or $52,500 of depreciation, and he's going to split that up evenly over 4 years. So that'd be $13,125 per year. All right, so now that we've got those expenses, I can have the pre-tax profit, which would be the gross profit margin minus those operating expenses minus the depreciation expenses. So my income taxes at 40%. Alright, so my after-tax operating profit okay. However, I need to adjust that because I don't actually pay anybody depreciation on the truck. So what we want to work with is cash flows when we're doing budget and capital project analysis. So the after-tax operating cash flow, take the after-tax profit and just add back the depreciation expenses. Okay, so that's the cash flows per year. We want to add those into all these other cash flows that are occurring at each of these periods. So all of these are cash flows, and so the total cash flow per period, just sum up all the lines that are in yellow, and if you set up your spreadsheet correctly, then this gets easy. And that just takes experience. And at this point, we just want y'all to understand how the concept works. So the total cash flows, that's what we're going to base our decision on. The cost of capital that Joe was using is 10%. If we calculate the internal rate of return, that's the IRR. We just cover up cash flows from time 0 through time 4. And that comes out to 16.5%. Alright, so my first piece of evidence, the IRR, if you have an IRR that's higher than your cost of capital, it's going to have a positive net present value anyway. So this is already telling me this is probably going to be a good idea. But I'm going to solve the other measures as well. So the MIRR uses the same inputs as IRR, and then you just input the cost of capital twice, as the finance rate and the reinvestment rate. And that's still higher than the cost of capital. To calculate the net present value, the present value of cash flows in years 1 through 4, use the NPV function. And that takes the present value of cash flow year 1, year 2, year 3, and year 4. And then I subtract the initial investment. And that's that $101,000 at time 0. So the net present value is $17,700. And the Profitability Index takes the present value of the future cash flows and divides them by the absolute value or the positive value of the initial investment. And that just tells you how many dollars you have coming in per dollar going out. Okay, so it's going to bring in $1.18 for every dollar invested. So that's the basic process of looking at project analysis.